Hey everyone, welcome back to Corporate Decoder, the place where we sift through corporate filings so you don't have to. Today, we're diving into the latest annual report from Cyngn, a company hoping to revolutionize industrial vehicles with self-driving technology. This report is a bit like a self-driving car itself, full of promise but maybe not quite ready for the open road. Let's see what's under the hood. Cyngn is in the business of making autonomous vehicles, or AVs, specifically for industrial settings like warehouses and factories. Instead of building their own vehicles from scratch, they create the software called DriveMod that can be installed on existing vehicles made by other manufacturers. Their whole pitch is that this tech can solve big problems for these industries: labor shortages, high costs, and safety concerns. The company highlights some recent progress like their DriveMod Stockchaser becoming commercially available, along with other vehicles like forklifts and tuggers. They've also secured projects with some pretty big-name customers. The aim is to be a technology partner, letting vehicle manufacturers focus on what they do best, while Cyngn brings the autonomous smarts. Cyngn sees themselves as riding the wave of what they call Industry 5.0, where robots and humans work side by side. They believe that their technology, particularly their Enterprise Autonomy Suite or EAS, can provide a universal solution for self-driving capabilities and data insights across many different industrial vehicles. The old automation focused on rigid, repetitive tasks like in the conveyor belt industry. But industrial vehicles like forklifts are still mostly driven by people. Cyngn wants to change that by adding self-driving capabilities to vehicles, which they believe will lead to substantial growth. Their core technology, DriveMod, uses a modular approach, meaning it can be adapted to different vehicles and environments. It relies on data from sensors to navigate, also collecting data which provides useful insights into operations. This data becomes an asset that companies can use to improve efficiency, safety, and maintenance. Cyngn sells the Enterprise Autonomy Suite, or EAS. EAS includes three primary pillars: the DriveMod software, Cyngn Insight that controls everything, and Cyngn Evolve for optimizing data. With these, they think they have a solution for any company looking to automate its industrial vehicles. Cyngn is trying to build out a full sales and marketing strategy, focusing on partnerships to drive growth. They're starting with manufacturers and distributors of material handling vehicles and plan to eventually expand into other industries and sectors. For now, the company's strategy is to focus on enterprise customers who operate on private property. That limits their exposure to government regulations, which can be a hurdle for self-driving tech. But the whole regulatory landscape is still developing, so it's something they need to keep an eye on. Now let's talk about the numbers. Revenue is pretty low right now at around $368,000 for the past year. But the company spent about $29.3 million in losses. This isn't entirely surprising for a company in the early stages of commercializing new technology, but it's something to keep in mind. And it's not going to slow down anytime soon. They also anticipate even higher losses in the future as they scale up operations, improve technology, and ramp up marketing. Because Cyngn is still in the development phase, those funds won't return anytime soon. This creates the risk of Cyngn running out of funds and has cast substantial doubt in the company's ability to continue as a going concern. They need more cash to keep the lights on, which might come from selling more stock or taking on debt. Let's shift to the risk factors. One of the big ones is that autonomous driving is still new and there are lots of uncertainties involved. The company relies on partners to build the vehicles and supply the components. So if those partners mess up, it could affect their own technology. Also, the market might just not accept self-driving industrial vehicles. The company also has a limited track record in this industry and faces significant competition. If Cyngn can't adapt to changes quickly or compete effectively, their business is going to hurt. Cyngn works with a lot of third parties, which can be risky too. These relationships may not lead to significant revenue, and disputes could always arise. Outside of the company's control, external events could greatly harm them. Pandemics, wars, natural disasters, things like the conflicts in Ukraine and Israel could really mess things up for them. These events can cause supply chain issues, rising costs, and volatility in the markets, making it harder to get funding. They have also had a material weakness found in their internal controls, which could make investors less confident. Intellectual property is a big deal for a tech company like Cyngn, and they face risks there as well. Other companies could claim that Cyngn is infringing on their patents, or they might not be able to adequately protect their own technology. Cybersecurity is also a major concern. Hacks or security breaches could compromise their data and systems, leading to all sorts of problems, including lawsuits and reputational damage. But at the same time, Cyngn is promoting good values and social responsibility. They want to make warehouses safer, faster, cheaper, and more environmentally friendly. Looking again at the financials, Cyngn did manage to raise a significant amount of cash through different stock offerings and agreements, especially towards the end of the year. But there were also significant losses and high expenses. Just keep in mind there was a reverse stock split in July and February to keep the price above Nasdaq's minimum listing requirement, so all the per share numbers have to be adjusted. Speaking of Nasdaq, the company is currently not in compliance with the exchange's minimum bid price requirement, which means they risk getting delisted. They had a hearing scheduled to appeal the delisting determination, and they performed a reverse stock split to increase the stock price. So, putting it all together, what's the take on Cyngn? The company is trying to do something innovative in a market with real potential, but faces some significant hurdles. They need to prove that their technology works reliably, that customers will buy it, and that they can manage their finances effectively to avoid running out of money. Cyngn is operating in a very attractive market, but there are quite a few risks involved. One risk is that they don't have as much control in their reliance on partners. This strategy may be efficient, but it depends on the partner doing well. It's hard to rely on your results to other factors. On a similar topic, many of their key leadership have worked for the company only for a few years. This brings a lot of uncertainty. If they can overcome these challenges and scale up their deployments, then Cyngn could be a compelling player in the future of industrial automation. However, it's a high-risk, high-reward situation. Thanks for watching. If you found this breakdown helpful, please give us a like, drop a comment, and subscribe for more corporate decoder videos. Until next time, stay informed.